How you doing today? This is Scott Kidd, the Yacht Captain Investor Podcast, and I have a friend of mine, Nizan Mosery, today. It has over 30 years of experience in real estate, multifamily, student housing, commercial space. How you doing today, Nizan?
I'm doing well, Scott. How you doing?
Oh, very good, and it's always good to talk to you. I don't see you around as often, I guess, because we're both pretty heavily busy, and I'm moving around quite a bit as well. But
you're always on the sail.
Yeah, we just got to St. Thomas today, so it's beautiful weather. Blessed for that one. Just tell us, for people that don't know you, just tell us a little bit about yourself.
Yeah, sure. I'm first generation American. My parents came over from Israel, and I was grew up in an immigrant home where English and American customs were the foreign. But I grew up, in New York City. And, since I was a little kid, my father drilled into me, that there's two types of people in this world. Those that pay rent and those that collect. And son, you always want to collect and all that kind of stuff. And he went out and he started us out in the real estate world. Bought a couple of properties in Manhattan. And growing up, I used to work all the dirty jobs and things of that nature. And I learned from the inside out. I had a renovation and restoration company in New York where we renovated, anything from single family homes to offices, transition office complexes into residential into office, all that kind of stuff. And then went into manage the properties as well. And at the age of 25, my dad passed away, and that kind of threw me for a downward spiral. And I didn't know what life was all about. I'd always heard, and I'm sure you heard also, money runs the world, right? Money's everything. It's all about the money. When my father passed away, I said to myself, what am I going to do? Work until I'm 65, 70 and then die? That's not what I want to do. There's got to be a better way. I packed up my stuff, moved to Israel, hung out on the beach for about a year, just contemplating my belly button and watching the sun go up and down. And then a friend of mine told me he was going to India for 2 months. I said, you know what? India, Tel Aviv, the beach is over there. The beach is over there. It's water, it's sand. Let me go check it out. So I went with him, and I stayed for about a year, continuing to just roam around. And I traveled from there. I just kept traveling the world for about 6-7 years, with no worries, no responsibilities. I had nothing. I didn't have a mortgage. I didn't have bills. I didn't have an income. I didn't have anything. I was just like living literally from hand to mouth on whatever I could do, odd jobs and things like that. And then in 2002, I met the woman who is now my wife and the mother of my 2 kids. And we settled back in Israel. And I opened up the first raw vegan restaurant in Israel and had that for about 2 years. And then I got into a bad car accident. I broke my hip, couldn't go to the restaurant anymore. And that kind of tanked. And I closed that. And we know what happened in 08 and 09, right? The world took a big hiccup. And so we sold our house in Israel. We moved to Florida, where I'm located now. And we've been here for the last 15 years. And, I started flipping houses, getting back into it slowly, doing all kinds of flips and wholesaling and things of that nature. While I was doing that, I was online at night, 2-3 o'clock in the morning, doing research and online research and whatnot. And I came across this guy who was talking about apartments and apartment investing and passive income and all that kind of stuff. And I said, you know what? That sounds like a lot like my father. That resonated with me. So I bought his home study course, and I did everything that they said not to do. I bought in the gang neighborhood in Chicago, in the south side of Chicago, on the wrong side of West Palm. I bought a 4-plex. I had prostitutes in one, drug dealers in another, her pimp in the other, and the 4th unit just kept rolling and whatnot. I made a lot of mistakes, and I started taking more courses and learning more, and slowly kind of just built my portfolio and went out there and made contacts and built relationships, met you, for example, and just slowly built out a portfolio. We've done over 2,000 doors. Thank God. It's been an incredible ride. We've had some tough years with the economy and interest rates and all these things going down. You got to learn how to kind of sit back and wait sometimes. That's the hardest thing. You're putting everything on pause, but I think it's better to pause than to get into a crappy deal and sweat.
It most definitely is. The lessons learned over the last couple of years have been pretty tough ones, like patience for the right deal. Everyone says they have that conservative underwriting, but it's conservative to their standards, so it may not exactly be, what you see, that everyone that has a bad deal right now is that their deals are going upside down. I'm pretty sure they all said they had conservative underwriting, but it's just one of those things. But I think it's coming back. I'm seeing, what are you seeing as far as the next, in the short term, the next 6 months to a year? Are you seeing more deals coming, or are you seeing more capital coming into the table? What do you see?
I got an email today that Fannie and Freddie reduced their interest rates a little bit, so that's always good. When interest rates go down, cap rates go down as well, which means pricing goes up a little bit. But I don't know how far pricing can go, because even though interest rates went up, pricing didn't really go down.
The buyer-seller spread was still pretty far on the seller side, and the prices that were there, you're looking at 60% LTV, and you have to either come in with to get that price, you have to put in 40% of the capital plus whatever or the rehab or whatever else you plan to do with it.
And, with that, the cash flow is enough to hold 6.5% interest rate, right? If you're buying at a 5 cap, that means that the property's throwing off a 5% return, and you've got a loan at 6.5, you're 1.5 points in the red.
Yeah, negative leverage already.
Right. How do you do that? So a lot of people are taking out bridge loans, hoping that the value will go there and things of that nature. And that's where a lot of inventory is coming to the market now, where people can't refi. They can't get out of those bridge loans because the equity's not there. They got to sell to save themselves from foreclosure. So we're seeing a lot of those types of projects coming to market now.
Yeah, that's true. You're seeing a lot of those. Like, they can't restructure it anymore. And some of these guys can't recapitalize or put in any more money because they don't have it. They've done the capital calls and the investors aren't giving them any money and aren't putting in any more money. It's getting really tight. They can't really sell either. So you're going to see some of them, especially the ones that are pretty far gone, that, like you said, they're negative leverage. And especially if their rates have adjusted and they've steadily gone up, you're going to see, but with commercial real estate and multifamily, especially it being takes so long for a transaction to happen, it's not going to be quick like we saw in 2008 or anything like that. And it's to much lesser degree as far as like the total amount. So you'll probably see it spread over the next couple of years. That's my thought anyway. Are you seeing more deal flow happening?
Yeah, a lot more deal flow coming down the pipeline. People wanting to get out. I'm looking at 190 units for $10 million. When you look at the rent roll, when you look at the delinquency report, they're about 70% delinquency on the rent roll. So you're looking at it, you're going, okay,
30% economic occupancy.
Like, okay, so what are we really buying here, right? Are we buying the delinquency if we're buying the cash flow? But again, if we get it at the right price and we want to do all that work and turn people over, but then again, it goes back into that same thing that we just talked about. We can't get an institutional loan because the cash flow is not there. You got to go in with that bridge loan, which is a risk, 24 months, maybe 36 months, and then refinance. And who knows where it's going to be in 36 months. A lot of guesswork coming in here, right? It's not where it used to be, where it was a sure thing.
Are you going to be able to get it all done in 3 years? The way supply chain issues and the tariffs are coming, your pricing and stuff, is that going to go up? How can you depend on a larger construction project like that? Or if you have all that value add, it's going to take you a bit longer. And then with labor and stuff like that, it could be an issue with immigration and stuff as well. Maybe you're not going to have enough people or the quality of the people. So there's a lot of unknowns there. Like you said, it's not an easy turnover like it used to be. But when you can solve a problem like that, that's where you're in the money, so to speak, right? I mean, that's why we do it anyway, is because we do our due diligence and know that we can get through that struggle there. Yeah, we can do this one. You got a great team. If you guys are up for the challenge and say they can do it, then you're going to be in the money there. And that's for sure. So 190 units for, would you say, $10 million? So that's probably going to be about like a 2 cap.
You got to wonder how these owners are paying their bills. I just flew to Little Rock to look at a property that we put on the contract. The owners bought it in 2021 for $5.27 million, and we put it on the contract at $4.8 million. They were distressed as well. And I went to walk a property because I told the broker, I said, listen, I'm not going to fly all the way out there and walk a property if my offer didn't get accepted. So if my offer got accepted, I'll be more than happy to come out there while we're punching back and forth the contract and whatnot. So I flew out there. I brought a couple of coaching students with me so they can see what we're doing and how we're doing it. And after walking that property, I reduced the price by almost $2.5 million. I said, from what we saw, they weren't as transparent as we would like. There was a freeze, so a pipe broke in the laundry room. Okay, they didn't tell us that. They didn't tell us about the mold issues and the foundation issues. They didn't tell us that the pool had been out of service for about a year or so. They didn't tell us about the erosion that's going on the property. So, it is what it is, right? So they went and they showed us 2 vacant units. And we walked around the property and we looked at every little tiny thing and the electrical panels and the AC units on the outside. And some buildings had gutters, some buildings didn't. So then we're all talking together. There's the broker. Now, mind you, also that the broker that we've been communicating with and we've been going back and forth with didn't even show up to the property. They sent some junior broker who we'd never met, never even heard of. He's over there. The property manager and I guess the regional manager or something from the property management company. So we're sitting there, we're talking, and I asked him, I said, so what's your occupancy like right now? Oh, we're at 90% occupied. I said, oh, okay, so you have 8 units. So we saw 2. You got 6 vacant units. Can we go see the other 6? We're here. I said, he goes, this is not an inspection. You're not going to walk through all the units right now. That's when you're your due diligence. I said, excuse me, I'm not walking all of the units. I just want to see the vacant ones. They're vacant. What's the problem? Well, they're not ready to be seen, to be shown. Dude, they're vacant. Show me the vacant units. I flew out here with 6 people. We're not going to sit here and look at 2 units. Just show me the 2 units. Just show me the 6. What's the problem? There's nobody living in there. They're vacant. We want to see it. What are you hiding? So that kind of really, ticked me off as well. And it's amazing how, you really have to ask the brokers the same question 5 different ways to really get the right answer. And I don't know if they don't want to be transparent up front because we're going to find everything out.
I've never had a sales job or what have you, but I find that if you just tell people, hey, here's the deal. If you want to come out here and take a look, I'll show you everything. There's potential here. Go through all the upside that you could possibly do on it, and then let them figure it out. If they want, they'll waste their time and stuff. But that is an understatement. That's not quite transparent. But it's a similar deal. That deal we're working on in Houston, it had probably sold for $12.5 million in 2022, and then the loan was being assumed for $8.5. And then at that price with the NOI, they were saying 90+% occupancy, but economic occupancy was about 60 something. Like we were saying, it's probably like a 2 cap. You're not going to be able to get any kind of conventional financing, so you got to either assume the loan or get a bridge debt or something like that, like you're saying. But that was the thing. My partner on that one, he was able to get the inside story from the guy and the group that on his team. The sponsor had owned it before, so that was a plus. And they have their own property manager, so they knew the property and knew what the upside is. That's like what you were saying. Just let us see it, and you can make the decision. Because if you're not transparent and something comes up, you're going to lose the deal anyway. Don't waste somebody's time to fly all the way out there with his guys and do that. But I think it's a different mentality. On the investor side, you have a different mentality. Hey, what can we do to make this work? And the brokers are more on the sales side of how can we sell this to this guy.
Absolutely, 100%. I always tell my coaching clients, what's the number one thing brokers want to do? Sell you the deal. They don't care if it cash flows for you. They don't care if you're successful. Now, again, not every broker, right? Brokers are worth their weight in gold. They're not out there just to sell you a property. They're out there to build a relationship, because they know they sell you a property, and if they're good and whatnot, you'll go back to them so that they can relist your property. They'll bring you other deals. It's a relationship business, right?
It definitely is. And I know my wife has a pretty heavy sales background with managing a bunch of Clinique stores, like 19 of them. She said, and she worked her way up from working retail, the registrar, all the way up to a regional manager, managing all that. She said, if you just listen to the customer for 2 minutes, they'll tell you exactly what they want. What I love is when you tell them what you want, and then they send you these 10 other things. I know you asked for this, but here's these 18 other things that have nothing to do with what you're going to just delete.
And I tell brokers, I said, listen, if you're going to send me stuff that I'm not looking at, I'm just going to delete you from my inbox. I'm going to block you because you're not listening to me. You're just pushing your stuff that you got to get off your book. You don't care. You're not looking at me. You're not interested in me, and I'm done. And it's funny because that process is the same thing when you're raising capital. You got to listen to your investor. You got to hear what they want. What are they craving for? What are their desires? What are their needs? And that's what I teach my coaching clients as well, is when you're raising capital, it's about building relationship, because the property is one thing, but they're going to invest in you. They're going to invest with you. Sharks from the Shark Tank, right? And they always talk to these people like, we care about the company and the numbers, but we're investing in the person that's running the show. Are you able to get it to the finish line? Are you able to work your business plan, right? So when you're raising capital, you got to listen to your investors.
I found that's common in a lot of different businesses. You really have to listen to what your client, your investor, and those things change over time too. Like at my age now, I'm looking for this and these type of things, and my risk profile is going to be different than someone else. Those kind of things, you really have to listen to them. And if you don't listen to them, you're not really going to be in line with what they are. And if you're not in line with them, you really shouldn't be dealing with them. Their risk profile is what they are, because you're being the steward of their capital. They worked hard for that money, so you should take every and all available information and precaution. It's like, for me, if it's my capital, I do my due diligence. I took the risk. I'm okay. Sometimes you win, sometimes you lose. Somebody else's money, I'm much more careful than that. I've had times where I've told people, like, well, since you have that 100,000, it's going to be locked up for 5 years. And they're like, well, can I get it back at certain? I said, no. So you probably shouldn't come into this, because what if your son or your daughter needs something for school? You won't be able to get it back. You're going to have to get a loan or something like that. Maybe do this a little bit later, but keep that money there just in case, because you may need it. That's just one of the things where you have to really look out for all your investors and your residents. If the residents love it there, the investors are going to be happy.
So how do you, as owner operators like us, right, when we have a fiduciary responsibility, just like you were saying, to maintain our investors' capital? Again, I teach my clients, you want to talk to your investors. If your investors are saying, hey, we want this, we want that, we want that, that's great. I appreciate what you want. However, to keep your money safe, we have to do what's best for the property. The property has to survive. It has to flourish. The residents have to like living there. They have to give good reviews. Property manager has to be paying the bills on time, collecting, making everybody feel good while being strict, right? Because this is our business, but it's their place to live, right? So there's a fine line. So for us to protect your capital, we have to go and do what's best for the property. When the property wins, we all win. And if the property loses, we all lose.
If you don't take care of the property, the residents aren't taken care of, and they move to a very competitive market that, people can go and move to other places if they get the a much better value for the same price, just like any other commodity. It's something that I think sometimes gets, lost in translation, or, people lose sight of that. They look at the money and stuff and how much they're going to make. But if it's not a good area and it's not a good place for somebody, and you don't really have to do this anymore, it's like, is this a property where once I get it going, could my wife go there and pick up the rent in cash? If that's someplace that I think I would be comfortable and she would be comfortable doing that, then it's probably going to be a decent place to live. And that's just something that a rule of thumb that I've used that I thought was kind of a simple rule. But because if it's a bad area, one, I'm probably not going to go there, and then people are not going to like living there. And like I said, you're going to have the drug dealers and prostitutes and everything. A lot of times people don't live those places by choice, just because it's the cheapest place that you can find. But I know also you've recently, in the last few years, you've moved into student housing, which I found that was pretty interesting, because colleges and universities are booming now. Having one daughter in college and about to have two next year. Yeah, so we got to buy more. It's not, what would you say the quick differences are between student housing and multifamily?
Yeah, it's a great question. So, so obviously student housing, it's full of students, right? The thing with student housing is that you can't discriminate, right? We're not connected to the university, but we're purpose built. So the property is built for students. For example, in one apartment, you'll have 4 separate studio apartments with communal living area, right? But again, if someone who's not a student wants to come and lease one of those little studio apartments, we can't turn them away. But you got to think, like, who would want to live with a bunch of students? But you have the people that do it. So the buildings themselves are purpose built student housing. It's by the bed. We have a property, I think it's like 85 doors, 85 apartments, but it's 250 beds. You don't lease it by the door, you lease it by the bed. So we have 250 beds. And what's nice about student housing is that if the student can't qualify on their own merit with income, if they have a job and things of that nature, we get the parents to guarantee a lease. If they don't pay or whatnot, guess what? We go to the parents, just like you, right? You don't want to get a call from the property manager, go, Mr. Kid, we love your daughter. She's great. She had a small party yesterday and there's about 6 holes in the walls. She refuses to pay. We're going to send you the bill. Right? That's the good thing, and like you said, universities, tier 1, strong universities, state-funded universities, that's what we're going after, right? Because no state is going to want to reduce the educational funds that are going, scholarships, state-funded scholarships and things of that nature. So they're growing. There's this thing called the Doug Flutie effect. They found out that every time Doug Flutie won a championship, the freshman class would increase and the population of the university would increase over the next 10 years. And they found that out. So we're going into universities that have a winning team, at least got into the Final Four. And I'll give you an example. We have FAU right down the block from me, right? Florida Atlantic University. When I moved to Boca 15 years ago, that was a small school. It was a nothing school. Nobody was talking about it. Nobody heard about it. A couple of years back, they got Coach Lane. He came in. He brought the football team to the Final Four. And since then, that university has exploded. My daughter went to apply and they're like, we have around 60,000 applicants. They don't have enough student housing in Boca to house all the students. The university's putting them up in hotels. Now, I would love to buy student housing or any type of property here in Boca, but first of all, it's too expensive. It's owned by 3 families, 3 big companies, all the land, all the properties, they're never selling. You got to go way out west Boca by the Everglades, by the gators and the mosquitoes. Those are the subtle differences from multifamily. But, student housing is a niche under multifamily, right? It's same, but different.
It's got, I would imagine you get a 1-year leases that have to be locked in because they don't want, like the parents especially, I know myself, like we just went through this, my daughter's getting an apartment and stuff like that, and we're looking to potentially buy up there in Orlando and stuff, but we got to lock it in ahead of time because it's now one of the biggest colleges in the nation, so it's hyper competitive for housing. If you don't lock it in quickly, you have an issue. You're going to be living pretty far from the school, and you're probably going to be paying more. That's not going to be good for her because her job right now is going to school. She has a part-time job as well, but her main thing is going to school. So if you take away from that, I would imagine it's very tough. I didn't realize how big the school actually was. I didn't realize what a huge niche that it's not really. It is a niche, but it's a huge market. Where I went in the University of Texas at Austin, like student housing, it was even back then when I was there, was hyper competitive to find a place just because there were so many students. You weren't actively looking. You just ended up not having a place and having to crash on somebody's couch.
Now, I mean, you got to get in on the pre-leasing season. You got to lock it in. If not, come September or August when you go to school, you don't want to spend your time looking for a place. So that's what I like also about student housing is that they're 12-month leases. It all starts on the same day and it all ends on the same day. You're not dealing with, June we have 4 leases coming due. September we have 6 leases coming due. It's all on the same day and on the same time.
So then you're obviously following up with them months in advance to see if they're renewing for the year and all that stuff. stuff where that, and the seniors obviously are potentially going to be moving on. Well, so yeah, I guess you got a rhythm to it as well. You can get a little more guidance and stuff, and that's a very unique business model. I would imagine it's very steady. I mean, you probably don't have much vacancy.
You don't have much vacancy because kids are locked in there, right? I mean, listen, again, sometimes it happens where the kids, they're on full scholarships, they're paying from their job and they lost a job and this and that. It happens, right? It's not a foolproof thing, but it's very rare to have high occupancy in the middle of the school year. Kid, they come in, they lock it in, they give you a deposit, and if they want to shift and if they don't want to come in after they sign the lease and give you, it's on them to find their replacement. Or we keep their security deposit, we keep all that stuff, and it's all written in their leases, and their parents review the leases and all that kind of stuff.
There's not a whole lot of last minute changes and stuff there. Do you follow any other things for student housing, like high-tech schools, stuff like that? Is there any other metrics you follow?
So what we look for is we also look for in-state scholarship universities. Florida, Georgia, Tennessee. I think Ohio also has it, right? So any of these state colleges, right? Big state colleges that have scholarships. So if your kid is doing well in school, in high school, and they go to a state-funded, school, university, they get the scholarship, so they have more money to pay for student housing and take care of that. We're looking for universities that have a strong, growing freshman class. Universities that are kind of landlocked, where they can't build anymore. There's not a lot of land around them to build. That's what we're looking for. Universities that feed into different sectors, like you said, Ohio State, into that tech sector, medical school that are growing. So all those different factors we do look at when we're looking into different universities. I think Texas A&M has a student housing that is right near where they're building 2 hospitals. That's a great place as well because, students will come there, probably in medical school, and they'll go work in the hospitals, interns or whatnot, and it's all in that area.
Yeah, it's a big system they have worked out where they'll be there for not just college, but through residency potentially and all those other things. Bryan College Station was, when I went to the University of Texas, was a small town. But now it's huge.
I was sent a 800-bed student housing in College Town. We're working on a deal right now in Miami with the university and a cruise line ship, a commercial cruise line, where the university has, it's 800 and something beds as well. And the university has a master lease on, I think, 300 plus or minus. Yeah, the Carnival Lines has on master lease on other units. But the university came to us, they came to the seller and they said, listen, we would love to have all of the beds because they're landlocked. They can't build. They can't go anywhere. There are also 4 smaller universities in the area. So they want to take on all the beds themselves. So as owner, you got a master lease with the university that's controlling all the beds. It's like a done for you deal. You don't have to worry about lease up. They just cut you a check every single month for the rent. Here you go. You pay the expenses. You do what you got to do.
They do most of the stuff for you. Wow, that's a really impressive deal. I imagine those are probably few and far between. There's probably not one owner that has probably a lot of smaller ones. I'd say probably, what would you say the average is? Probably 200 to 300 beds?
100 to 200 beds. Those are the decent size. Those are good size properties. Anything above 300, you got to be in a university like Central Florida, 40, 50, 60,000 students where, okay, you know what? 300 beds is not a lot, right? But if you've got a university of 10,000 and you've got 600 beds, that's a lot. That's
You're probably controlling a good chunk of the market there. Not all of them are going to go into that student housing.
A lot of the bigger universities that are exploding, the mandate was freshmen have to live on campus. Yes. Sophomores have to live on campus as well. And a lot of these universities are changing that mandate and they're saying, sophomores, go live because we don't have enough for the freshmen. And some of the universities are telling the freshmen, first come, first serve. If you don't lock in, we don't have enough to cover you guys. You're going to have to go somewhere else and live.
That's interesting because I think with UCF, I don't think it was required. I think it was preferred or it was encouraged. I think it was better for our daughter as well to be right on campus and learn your way around because I think it's much tougher to go be driving to school and then trying to figure out where you are. If you're there, you can kind of get the lay of the land a lot quicker. And she said she was walking 7 or so miles a day. So then she got a car and everything else. That's really eye-opening because it's something I don't really know a whole lot about other than talking to you and a couple of other people because it's a very niche thing and that just shows like so many ways to do it because there's not just one way. Like we were talking about earlier with the investors, our tastes also change as we get older or get to a certain stage. I've seen a lot of people go into private credit and stuff like that, and instead of seeing a lot of equity group pull back and they only do debt now, they don't do any equity into these deals, I guess, because they're a little hesitant. What do you see in not just in student housing, but in multifamily, like over the next 5 years? What do you see the overall trend? Do you see it being a strong market?
Well, yes, I'm gonna share something that kind of like a light bulb went off in my head the other day. Now we've got a new regime in place right now, right? And he's doing all all the, now like them, don't like them, I don't care. We're not talking that right now, but you got to look at what's happening, right? You got to look at what's going on. So he placed tariffs on different companies. Now with these tariffs in place, what are these companies doing? They're now coming back to the US, opening up manufacturing plants and going to be creating jobs in certain areas. Why not look where these places, where these companies are coming in and opening up factories and bringing in 1,000, 2,000, 5,000, 10,000 jobs in 4 years, an undervalued multi-family property with the people that are coming in to fill up these jobs, and now you've got an incredible flow
of jobs.
So that will turn on equity players, I think, as well, that you have a concept that you're not just going out there and just buying a multifamily property for the sake of buying a property, but you're following a trend, seeing what's going on. What is it? Taiwan Semiconductor, one of the largest semiconductor companies in the world. They're coming and they're opening up a plant over here in the US. Why not go where they're opening up manufacturing plants and start buying properties? You know that value is going to go up. So in that aspect, I think there's going to be a lot of movement, a lot of acquisitions in there. What's going to happen with interest rates and whatnot? I wish I had a crystal ball. If I had a crystal ball, I'd be on that yacht behind you right now with you.
I see probably with some of these things, there are going to be some short-term pain, but there was going to be some short-term pain with the yield curve coming out of inversion anyway. That was in about 6 months. So you're going to see some of that. And then with all this other stuff's going to have to play out. So interest rates are going to be, prices will adjust like they did in the 80s and 90s. Prices will have to reflect what the rates are and everything, what people can purchase at and what people can afford. Even before all this stuff where it's been a slow trend, has probably increased that more manufacturing in the U.S. because the CHIPS Act over the last 4 or 5 years, they've been doing that. And I know because we were heavily looking in like Texas and Ohio, because they have just all these chip factories like you were saying, and those are high-tech jobs that pay well. What I see being some kind of an issue is it's tough to build like a Class B type property. Class A, you kind of have to build at that realm, but I see more like a lot of those tax abatements and things that they're doing in Texas where they're giving tax breaks and capital gains breaks and stuff where people can build and afford to build to where a certain percentage of it will be a lower price point, won't be the highest quality, which I think is pretty exciting because we're behind as far as building. I don't think there's a lot coming online over the end of this year in 2026. So I think rents will probably moderate and start ticking up again. And then building will have to start going again, regardless of where the rates are, but things will have to correct. I think it's a pretty bright future for multifamily. There's going to be a bit of pain, but somebody's pain will be somebody else's opportunity. We've all been there on both ends of it. I don't wish for anybody to be, in pain or what have you, but if it's an opportunity, maybe we can solve that problem for them where maybe they can get out of it easily and they don't maybe take some of that pain away. There's going to be a lot of opportunity there because we have to be, we don't necessarily have to be sympathetic. We can be very empathetic because you don't really actually know what they made the right decision at the right time, or maybe they didn't. It was a great decision at that point, but then no one saw the rates going up that high, seeing all these supply chain issues and all these other crazy things that we can't anticipate. What's the future look like over this year? You got anything that you're working on that you'd like to share?
I've got a 3-day multifamily event coming up May 2nd to the 4th. I've got some incredible speakers coming. I've got a doctor of psychology coming and really going through the process of helping people not only set goals, but actually really achieving them. We always hear people talking about write down your goals and then go after this. And then how many people really, first of all, do that? And then those that do that, how many really actually achieve their goals? It's very elusive, that whole system, that whole process. So I'm bringing someone in that's going to go and really pave the way and show step by step, understanding the mind, understanding where we have to be and all that kind of stuff. Then I got someone coming down who's going to be talking about demographics, how to find the right markets using demographics and all that. And so you can really pinpoint all that. My master underwriter who worked for some of the largest auto manufacturing companies, he was a CFO for them. He's going to be really diving into the underwriting and analyzing so that people don't make the mistakes that past people did. But again, like we said, you can be conservative and things still happen, right? But underwriting correct is crucial. So I've got that coming up May 2nd through the 4th. It's going to be here in South Florida. Cheap tickets. It's $297 for 3 days. We're going to blow your minds away. I've got some incredible workshops, like interactive workshops that we're going to be doing. I've got a Tony Robbins trainer that's going to come and do some training with us as well. We're going to talk about how to network, how to go out and capital raise, putting systems in place to really go out there and do that. So that's May 2nd through the 4th. Working on multiple projects right now that we're underwriting. Like I mentioned, I flew out to walk an 80-unit property. Unfortunately, that didn't come through. But because of that, we built relationships with a few other brokers that sent us more deals. I've created an opportunity zone fund that we invest in opportunity zone. So, if you or if anybody listening here has a capital gain and they don't want to pay capital gains tax,
that's great.
and you don't want to do a 1031, and you want to put money into a fund that's going to grow and help you not pay that 23% capital gains tax and whatnot. So we're doing that, and we're underwriting multiple deals right now in different opportunity zones. I was just sent the property right now that in Galveston, Texas, like 7 units for $170,000, where we can rent out everything. It'll be about $7,000 a month of income coming in. That's a great place to park your money as well in an opportunity zone. I've got a couple of markets that I'm eyeing that I'm very bullish on, that we've been diving deep into them, and we should be getting some nice deals coming through the pipeline.
I think it's pretty exciting. There's quite a bit of deals coming. Sounds like a pretty great event. I think I'll be in town, so if I do, I'll definitely come down and come visit with you guys for at least a day or so.
That'd be great.
I know I'm the captain, but at home, my wife's the admiral. I just follow orders. I don't know if we have anything going that day. I mean, it's just a lot of exciting things going on. The Opportunity Zone Fund, I know we had a property in West Palm Beach that was in Opportunity Zone, and it's a great advantage, especially if you have people with 1031s and they can roll right into it and move and not have to pay that capital gains. What is it with the Opportunity Zone? Is it 10 years if you hold it for? You pay no capital gain, no depreciation recapture? Is that
no depreciation recapture? You can refinance in a couple of years after the value goes up. You can pull money out tax-free because it's a loan. They're saving that 23% or whatever it is on the capital gains. They're getting the cash flow. And then 3 years you can refi, and then 3 years later you can refi again as that valuation goes up.
You're pulling out debt, so it's not a profit you're getting. So no, that's brilliant. I think the timing is exactly perfect for something like that, and I think that's going to be a lot more common. And I know it'll go well for you. But for people that are listening, if people want to find out more about your event or what you're working on, or just connect with you, how would they find you?
Yeah, sure. So feel free to email me. It's my first name, Nizan at mtninvestmentgroup.com. If you want more info on my coaching program as well, you can go to Multifamily Inc. It's right behind me, multifamilyinc.com. I have an application link up there. You can fill out the application and I'll reach out to you as well. We're going to put a link in that website as well for the event. I don't know if people will be able to see. My phone number is right there, so you can feel free to text me and call me and we can have a conversation.
That'd be great. I really appreciate you taking the time to come and talk with me today. And it's always fun. I always like catching up with you. It's always a great time. We always have a great conversation.
Absolutely, man.
Appreciate it.
Yeah, I appreciate being here. Thank you.
Thank you so much. That's the Yacht Captain Investor Podcast out. See you guys next time.